Rui, how nice to see you again. And Louis, thank you. And congratulations to the university on its 25th anniversary. As you can tell, ladies and gentlemen, from the way in which I got up those steps, my days as a soccer coach and a soccer player have now somewhat disappeared into the background. I have a twisted right knee. In thinking of how I would present to you, it struck me that a good way, not necessarily the only way or the best way, but a good way to deal with this issue of international trends and then possibly the implications for Portugal, but with the international trends, good or bad, would be to try to identify the immediate trend or problem, the medium-term challenges, and the longer-term challenges. I realize that in half an hour, that's a very difficult thing to do, Madam Chairman, but let me see what I can make of it. The immediate crisis is clearly the European financial crisis. It is difficult for me to open a paper these days, especially ones really interested in finance, like the Wall Street Journal or the Financial Times, and not to see that there's another crisis, another retreat of the bondholders, another alteration in exchange rates. And sometimes it takes us a while to ask ourselves, how did this start? In a way, I think it started back in 1971 to 72, when the Nixon administration ended what we called the Bretton Woods system of fixed exchange rates, all of which were related to gold at a fixed price per ounce, and allowed the floating of exchange rates and the floating of gold. Things became marketable, tradable. They therefore went up, and they also came down. The next stage was probably in 1979 to 81, when first Mrs. Thatcher and then Ronald Reagan took away currency controls from the citizens of their two countries. I do remember as a young graduate student coming to this country, particularly coming to Germany, and having solemnly to go to my Barclays Bank and have 25 Deutschmarks taken out, or 25 pounds taken out, a notation put in my passport that had been taken out. That was the nature of the fixed rates. After that, the genie was out of the bottle, and the genie could be as much an evil and predictable genie as it could be a beneficial genie. It released trillions of dollars of fluid capital, for good or for bad. And it's now probably completely impossible to put those genies back inside the bottles. The consequence of all of this fluid capital is that those who operated, those who manipulated, have created an interconnected world which even the bankers didn't really fully understand. In the past few months, perhaps all of this year, one of my banks, my local bank, Bank of America, has dropped 75 to 80% in its share value. And you may well say, well, what has the crisis in Greece got to do with Bank of America? It has its own problems with excessive bad loans in the United States and with the overextended set of bank branches and with poor management. But why should the Greek crisis be driving down its price and the price of Wells Fargo? And the answer is this interconnectivity. it turns out the Bank of America has a large number of holdings in the French banks of Paribas and Société Générale, and they have very large holdings in, say, Italian government bonds. So an Italian bond crisis hits banks in which the Bank of America is deeply invested. It cannot get away. It cannot get out. The third consequence came along with the arrival of what we call small, independent hedge fund traders trading futures in every conceivable commodity, not just any longer in oil or in gold, but in all sorts of other things. And trading futures in government bonds, municipals, and anything you might care to think can be traded is being traded. It is being hedged. Most of those individuals pulled out of working for a large bank like Morgan Stanley or Goldman Sachs because they thought they could make much, much more money than the vast amounts of money they were already making if they were independent traders. All the money would come to them. It would not need to go to the chairman or the shareholders of Goldman Sachs. But their promise is that they will make their clients, generally the clients are private, but they can be pension funds. I have a hedge fund trader who's very, very well read, comes into my weekly reading class, and one of his responsibilities is the University of Massachusetts Pension Fund. All of these traders promise that they will make higher return than the average market return. And therein lies the problem of volatility. Because if you're not making a high enough return, if you're just making average, you're no good. People will pull funds away from you. So you try to make your trade very quickly, make a profit on it, and get out before the others wake up in the morning. You act on rumors, you act upon sometimes substantive reports by research agencies, but you act. If Italian bonds, interest upon, go above 7%, you sell like crazy, and Wall Street goes tumbling down by 424 points. If it goes down, if the Italian interest rate goes down as it did in the middle of last week to 6.5%, which is still unsustainable, you buy, and the stock market goes up again. In fact, the people who play the stock markets are essentially clueless, or headless, or rudderless. They do not know what will happen next. They do not know whether by Sunday evening there will be a sell-off in stocks or bonds in the great markets of Tokyo and Hong Kong and Shanghai. They do not know what they will find when they get into their stock markets at 8:30 or 9:30 next Monday. This has led to a nervousness, a finger-pointing, and to an examination of every country and its viability and the viability of its bonds. The most surprising thing last week was that the spotlight shone now on countries like the Netherlands, France, Finland, Austria, with very, very strong credit accounts and a very strong economic profile, but nonetheless, the LIBOR rate and the interbank rate, that's the overnight London interbank rate, and the bond prices between any and all of those above countries and Germany itself had widened a little. And if it widens a little, it might widen more. So it must have come as quite astonishing to the finance minister of the Netherlands or of Finland or of Austria to learn that they were in the spotlight, not as badly as Greece or Italy or Portugal or Ireland had been, but nonetheless so. This is leading the European Central Bank to make purchases which it had no intention or no dream of making a year ago. That's our short-term crisis. Phew, does anybody want a drink? The medium term I've divided into three. One relates immediately to the topic I've just been talking about, and it is the dilemma, the problem of having a common European currency without common European fiscal policies. There's no way, if you ever took an economics class like the Basic Economics 101, there's no way you could have a common currency without the fiscal policy within the territorial borders being the same. Otherwise, you'll ne marche pas. Das geht nicht. That's a medium challenge, and it's very hard to see how it's going to be solved, possibly without Greece, say, being put in some suspension. The second medium challenge, and who knows, we might in a year's time think it wasn't a medium challenge, it was an immediate and massive challenge, is the Arab Spring. Is it going okay? Is it beginning to go wrong? Will we find a mixed package? Will we find that our hopes that one person, one vote in the Muslim world will lead to majority votes for parties which are less than tolerant and less than democratic when it comes to dealing with, say, their Christian minorities, their Copts, and their neighbors? Will we see this convulsion spread closer to Portugal, to Algeria, to Morocco? No one knows. The third medium-term one, and again you could say that Professor Kennedy, this is an immediate one, is the US fiscal crisis. It clearly is not going away. The slow growth in the United States seems unlikely to be transformed into fast growth. And without fast growth, there's no way the budget deficits can be closed. And by budget deficits, bankers are now beginning to see that you have to look at the total US indebtedness. So it's not just the federal government, it's all of the states' governments, all of the city and municipality governments, company debt, and individual debt. And put together, that makes the United States in more debt per capita or as a percentage of GDP than at any time, ladies and gentlemen, since the year 1929. The slower growth in the US hurts our European exports to there. It hurts Chinese and Japanese and Korean exports to there. Slower growth in Asia means that the hopes of billions of people to gain a comfortable standard of living will be postponed. And in particular, developing countries will be hit, as they were in the Great Depression of the 1930s. As to the longer-term challenges, the global challenges facing our community, well, I feel inclined to say, ladies and gentlemen, take your pick. Take your pick. Which of these do you think is the one which concerns you most? the global environmental pressures, which are manifestly larger, I was going to say decade by decade, but nowadays it almost seems year by year. The enormous potential shifts in energy production fields and the implications of that. I'd like to go to that in the question and answer if somebody raises a question. The medium to long-term future of Israel, which I find massively problematic. The relative decline of the United States in its capacities to influence the world order and world structures, disguised a little at present by the stronger dollar, but the long-term trend is downwards. And it is interesting to speculate, if you think about it, what the world of finance and trading would be if it was a world of 3 large reserve currencies rather than just one large reserve currency. I haven't worked that one out, but I'm willing to speculate a bit if, again, at Q&A, we think about that. Then there's a military overstretch of the United States and the changing military balances, particularly in Asia. And then there is a possibility, strong possibility, of military conflicts in disputed regions of Asia. So that, Madam Chairman, is my shopping list of the challenges, immediate, medium, and longer term. And so you might say, well, what on earth or where on earth are your good things? What is good about what's happened in this world? And I would say, first of all, there has been no World War III. That would astonish a large number of policymakers of the 1960s, 70s, and 80s. No World War III. No chance of a massive European war. Again, I think. No nukes exploded in violence since Hiroshima and Nagasaki. And a spread of prosperity which we mightn't see now because we're so concerned with our short and medium term financial and economic challenges, but a spread of prosperity since the early 50s, which has been unprecedented in the whole history of the world economy. So in the midst of all the gloom and doom and northern rain and mists which I bring to you, I bring some reflections on sunshine and bright sunlit uplands, to use Churchill's phrase. Thank you very much indeed.